Welcome, everyone, and thank you for joining our Upside Avenue educational webinar series. This series is developed with your input. We surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we look for subject matter experts all over the country who can speak on these topics in hopes of providing you with knowledge and confidence to discover your upside. Watch your email for information about next month's webinar, and we'll also share it through our social media channels. So today's speaker is also a fellow Austinite. He has won numerous awards for helping clients pursue their financial goals. Prior to founding IronBridge, he's been recognized as Wells Fargo's premier advisor for 10 years in a row, and he received a nomination as a Barron's Top 1000 advisor. No stranger to working with the big players, he also spent time in his career with JP Morgan Chase and Morgan Stanley Dean Witter. His commitment to service also carries over to his involvement with the local Austin community. He currently serves on the board of the Austin Symphony and the Dell Medical Children's Trust. As husband and father to their two sons, they can be found enjoying everything that Austin, Texas has to offer, from live music to cheering on the Texas Longhorns. So please help me welcome founder and CEO of IronBridge Private Wealth, our guest speaker and friend, Jim Denholm. Welcome, Jim. Thank you for joining us today.
Thank you for having me. Excellent. Well, thanks everybody for joining us today. It's enjoyable to be invited by the good folks at Upside Avenue to participate in this. Before we get started, I would like to say that we do have, we are working from home, and we do have a couple of small kids and a couple of big dogs. So if there is any distractions in the background, please forgive any background noise. But when we set this up a few months ago, it was actually the early part of this year that Upside approached me about doing a webinar that dealt with protecting portfolios, managing during times of volatility, and wow, did we time this thing right. We have seen a little bit of volatility this year, and so hopefully this is going to be a useful webinar for everyone. We would like to keep it pretty open. If you do have questions, please put that in the question and answer. We'll try to get to those throughout the meeting. We will have a section dedicated at the end for Q&A as well, but we would like this to be pretty interactive. So with that, let's go ahead and get started. Like Jessica said, here's my background. I won't go over it again. I am founder and CEO of IronBridge Private Wealth. IronBridge is a registered investment advisory firm. We deal with individual clients and do portfolio management, financial planning. We're very active investors with strong risk management. We do comprehensive planning services, and we have flexible fee options. If you'd like to learn more about us or get on our email distribution list, you can visit us at ironbridge360.com. So let's talk about what we're going to go through today. Investing during times of volatility, there is no one right answer. There's a million different ways you can do it, but let's talk about some of the bigger things that people address. So first of all, 99% of the investment industry base portfolio risk management on asset diversification. Unfortunately, that tends to fail when you need it most. So we're going to go through and talk about that. We'll talk about the two biggest mistakes that investors make, how you can try to avoid those, and then talk about the foundations of building a reliable investment process. If we do have time permitting, we're going to go over a brief market review, but we would prefer to have time to answer all of your questions. So before we get into it, it has definitely been a volatile market. This is the S&P 500 over the last 2 or 3 years. We've seen multiple very large declines. So this chart along the bottom shows starts at 2018. We saw a 10% decline. early in 18, followed by a 13% rise, followed by a 20% decline, followed by a 44% rise. Then we had our COVID crash in February and March. The S&P from peak to trough was a little over 35% decline in just over 6 weeks. That is definitely a market crash by any measurement. Not to be outdone, the bulls came back and we saw a 60% increase from the lows, a pretty amazing surge. Over the last few weeks, we've seen now a little bit over a 10% decline. So we have definitely seen some volatility over the last few years, and it's to be seen whether this continues or not, but we'll talk about some ways that we can help you address it. Long-term bear markets are down markets. They can last much longer than many people think possible. So risk management is not just something that you use temporarily. There can be as we can see on this chart, there are very long periods of time where the market is essentially flat. This is a long-term chart of stocks that goes back to the late 1800s. And we can see there are 50, it started with a 24-year period of flat markets, a 27-year period following the 29 crash. And in the 70s, we had 15 years of basically no price movement. And then 2000 to 2015, we had another 15 years where basically prices were flat. So if you're an investor and you're nearing retirement, you're at retirement, and you're basing your long-term projection on markets always going up, you need to be prepared for the potential for there to be very long periods of flat to down markets. This is really where risk management comes in, and investing in having the tools to invest in a volatile market become very, very important. So let's talk about diversification. It's failure when you need it most. Diversification is a good starting point. It's better than nothing, but it's not quite as useful as many people think and as many advisors sell people on. This was started by a gentleman named Harry Markowitz. In the 1960s, he developed what's called modern portfolio theory. And it's based on the assumption that a diversified portfolio of assets, so having different assets in your portfolio, stocks, bonds, cash, commodities, US stocks, international stocks, that by having a mix of these different assets will ultimately lead to higher returns, but also lower risk than a more focused portfolio. And one of the key quotes that Harry Markowitz made regarding diversification and asset allocation is that to reduce risk, it is necessary to avoid a portfolio whose securities are all highly correlated with each other. Now, this means how they perform together. So if you have two different stocks, for example, and they go up and down with the same rhythm and up and down at the same time, you're not getting any benefit from owning those two different types of securities. So an ideal portfolio, in order to manage risk, has things that are non-correlated, that when they fall, you have some predictability that other parts of your portfolio are not going to fall as much or not going to fall at all. So let's take a look. This is very good in theory. Mr. Markowitz was an academic. He did not necessarily practice in the financial world. So let's take a look at some real life examples. Well, first of all, let's look at a sample diversified portfolio. So very common. If you work with an advisor, if you worked at a big bank, if you've read anything from Fidelity or Vanguard, a lot of it is preaching modern portfolio theory and diversification. So a sample portfolio might have 30% in large cap stocks, have some small cap stocks, international stocks, emerging markets, high yield bonds, more diversified kind of broad-based bonds, maybe some commodities. And the idea is that if we go through a period like we did in March, where we have this 35 and in some markets up to 50% decline, that some of these assets are not going to be correlated. but let's really look to see if that's the case. Here is a look at two different periods of time. So we have 2008 on the left and 2020 on the right. I've zoomed in, so if we want to focus on the chart on the right, this is asset performance of those different investments in this COVID crash. So these various lines represent the S&P 500, large cap stocks, the Russell 2000, small cap stocks, international stocks, emerging markets, high yield bonds, the US Ag Bond Index, gold, silver, some publicly traded REITs. So what we see is that if we're looking at this chart on the right, when markets underwent stress and when you needed to have different assets performing differently, it did not work. Correlations rise when markets undergo stress. This is not just unique to 2020. The chart on the left shows the summer and fall of 2008 when the bulk of the financial crisis sell-off was happening. The same assets, everything became very highly correlated when markets undergo extreme stress. This is the case in 2020. It's the case in 2008. It was the case in some mini crashes in 2015 and 2016. When the US debt was devalued in 2011, this happened. In the tech bubble burst in 2001 and 2002. This happened in 1987. It happened various times during the 70s. It happened during the 30s. It happened in the early 1900s. It happened in the late 1800s. This is not a unique phenomenon that is a result of technology or news spreading fastly or the ability of people to react. This is something that happens every single time the market undergoes stress. So if we are looking at what might be a better way to approach it, at IronBridge, we think there's one asset that's predictable in times of stress, and that's cash. Cash is king. The ability to move to cash is the single most important risk management tool that you can use. So it sounds very easy. It sounds a little simple, but creating a way to systematically increase and reduce cash exposure within your portfolio is more difficult than it seems. But there are opportunities and risk of using strategies like this. The obvious opportunity is that you reduce your volatility. Cash will not fluctuate when markets undergo stress. It's predictable. It is non-correlated. You don't have the exposure to downside like you do with these other various assets that are thought to do well in periods of volatility. So you can reduce your volatility in your portfolio. You can protect your portfolio when times of volatility rise. And if you've been invested for a period of time, you can lock in some of those profits. So using cash is a very, very effective tool. There are some risks associated with it. We call it a whipsaw risk. If you sell, you're not always guaranteed that the market's going to keep going down. There's times where you sell and the market starts to recover. So if you might have to get back in at a higher price than which you sold. There's also some potential tax implications. If you do have long-term gains and you have some turnover and you're moving part of your portfolio to cash, you could increase your net tax exposure. We believe that both of those risks are more than compensated by having a more predictable way to reduce volatility. So we think cash is king. I would take a little pause to see if we have any questions. Jessica, do you see if we have any questions yet? It doesn't look like it on my end, but.
I don't see any at the moment.
Okay, great. So diversification is, like I say, it's a good foundation. It's better than nothing. but it is not necessarily the end all be all like many people say. Um, Changing gears, if you have the ability to move to cash, or you have cash in your portfolio, or you're following markets, if you don't have just a purely buy and hold mentality with your overall portfolio, there are really two big mistakes that we see investors make all the time. And successful investing really only occurs when you have the ability to control your emotions. Howard Marks, let's see here. Howard Marks is one of my favorite investors to read. He has a number of absolutely wonderful books. His latest one is called Mastering the Market Cycle. Highly recommended. If you can get your hands on that, you can get it through Amazon or anywhere else. And he had a quote that was, "The biggest investment errors come not from factors that are informational or analytical, but from those that are psychological." It is within us individual investors that lie the problem. And understanding that can help you start to approach a solution. This has been sort of proven and plays out multiple times. This is a chart from Russell Investments. You can find many different versions of this, but there's an emotional investment cycle. If you've invested at all in stocks, you've probably experienced all of these at some point. And if you've invested in 2020, you've probably experienced all of these at some point. But basically, it's the how you feel about your investment is very much at odds with what your potential risk return is. So if we look at the point of maximum financial risk over here on the left side, it's typically when you think that nothing can go wrong. You experience good growth in an individual stock or your overall portfolio. You are excited about how your portfolio has done. You get to the point where you feel like you can do nothing wrong. And typically that's when you should be most cautious. But what tends to happen is that as we go right down the side of that slope, the market starts to sell off a little bit, or your stock starts to sell off a little bit. And the initial reaction is denial. And you say, well, it's, things are good. The economy's doing well. The company's in good shape. This is just a little blip. It starts to sell off a little bit more. You start to feel a little bit of anxiety. You start to get a little more anxious about it. Well, maybe this is turning to something a little bit bigger than what I thought it was, but that's okay. I'm gonna hold it and ride it out. You start to get fearful that maybe it's down 10 or 20 or 30%, and you really start to worry about what this could do to your long-term financial health. You then get into a depression and start to panic. And then capitulation is a sign of just throwing in the towel. We probably all have done this at some point. We didn't quite see that a lot this year. In 2008 and 2009, we saw people do this very widespread. You just say, I can't take it anymore. Get me out. I'm going to sell. What am I doing? I ruined my retirement. I'm going to have to work for another 10 years. And you just throw in the towel. That's typically when you have the best opportunity. So as the market starts to go up, there's skepticism. And you say, well, look, we're experiencing it right now. Despite a very strong move off of the lows, despite the last couple of weeks sell-off, 60% move off the lows, we're still seeing a lot of people that are skeptical of this market, that the economy just is not in good shape. We've got an election coming up. So a lot of skepticism out there is actually pretty favorable for the overall investing environment. So the key here is to really understand your own emotions so that you can try to combat those, and avoid making mistakes. So let's move on to the first mistake.
We actually do have a question that's popped up.
Okay, great.
It says, what is the current amount of cash protected by FDIC in a bank account? If you have family members, do you get extra coverage for each person? Do they also have to be listed on the cash account?
Yes, it's per type of account. So if you have an individual account, it's $250,000 that's FDIC insured. If it's a joint account with your spouse or parents or something else, that you each would get 250,000. So that would be 500,000. If you have a retirement account, that would be an additional 250,000. But the FDIC insurance part of it is not necessarily the most important part. The most important part is essentially being out of the market. There are various cash equivalents that are just as good as FDIC coverage. Maybe it doesn't give you a guarantee, but the idea is that you reduce volatility, that you don't have exposure to that downside. Many firms will use multiple FDIC coverage. For example, our custodian, where our clients have accounts, is Raymond James, and they have deals with 10 different banks. So they have $2.5 million of FDIC coverage. So it varies, by each individual firm and who you're dealing with. But as an aside, I worked for Wachovia when Wachovia was essentially going bankrupt. If anybody still remembers that bank. And, if things get really bad, that FDIC coverage may or may not actually pay. So the idea here with cash is something that doesn't have fluctuations. It could be very short-term treasury bills. It could be a Fidelity money market fund. It could be FDIC insured cash. So, but the idea is that it's out of fluctuation. It's not in something that would fluctuate. So good question. So back to the mistake. The first mistake that investors make is simply staying invested too long. We like to talk about this internally. We like to talk about this with our clients. We don't want a small loss to turn into a big loss. And again, easier said than done. There is so this is a chart of the S&P 500 updated through yesterday. And this is through this part of this year. It's about the last 4 months or so. We've had a 10% pullback. What if the market does this? What if it continues to sell off? We see something similar to what happened in March. You want to have some kind of exit. Personally, we don't care why. We don't care if markets are falling because of the Fed, if markets are falling because of the election, if markets are falling because the economy is in shambles, or if it's World War III, or if it's a blip in the road. We don't care why. We want to understand why. We want to understand the context. But markets are very, very complex systems, and they are too complex to be able to predict with any consistency or regularity. So we're trying to remove our own ideas of what the market should or shouldn't do, and remove our own emotion from it, and just deal with what is, not how we wish it to be. And the easiest way to do this is with a stop loss. So a stop loss is simply a predefined exit. You can have this on one position. You could have it on every single position in your portfolio. So if you're invested, what is your exit? You could do, there's a million different ways to define what your exit is. We typically look at if it's a certain percentage drop. So maybe an 8% drop from the high would cause us to sell. We do have some different stop losses that are based on what's called relative performance. So how are these particular assets doing versus the S&P 500? A lot of times we'll have kind of signals that are combined. If it drops a certain percentage and these other conditions are met, we would then sell. But the idea is that you have it planned before you need to implement it, so that you're not trying to figure it out on the fly. This is a very, very simple thing. It's very, very difficult to implement. But it's again, if the market wanted to go down 50% from here, having a predefined exit, having a stop loss would help protect your portfolio much better than having just a diversified portfolio or a buy and hold portfolio. Some of the risks of a buy and hold portfolio are simply you lose the commodity of time. That is the single most valuable commodity we have as investors, is time. And if your portfolio experiences big losses, you lose that commodity of time. So staying invested too long is a very, very common mistake. The second common mistake is its twin brother, and it is staying in cash too long. So you've taken steps to, let's say you had a predefined exit, you had a stop loss that was triggered, and you moved your positions to cash, or you moved a portion of your portfolio over to cash. Now what? What if the market does this? And it doesn't go down 50%, and it turns and starts heading higher. Very, very much a reasonable thing that we could expect right now. The Fed is massively printing money. There are tremendous uncertainties out there, but the market could easily head much higher from here. So what if you did move to cash? What then? The ironic thing is, if you develop a system to be able to get out, many times getting back in is much harder. It's much more emotional. You want to be right. You recognize the risks that are out there, and we see many people that we talked to this year are doing the same thing. They have a lot of cash. They've taken steps to protect their portfolio, and they're very skeptical. There's a lot of potential risks, but what do you do? So just like if you're long and you own a stock, or you own stocks or whatever asset, and you have a predefined exit, it's equally as important to have a predefined re-entry, and have that something that is not based on how you feel about it. Because when you feel good about doing it, it's probably too late. You've probably missed the bulk of the rise. So it needs to be very, very objective, and there needs to be buy criteria that you lay out beforehand. Because when it's time to implement it and it's time to execute it, chances are you're not going to want to. You just sold, a couple weeks later, the market reverses. You were wrong, and it's hard to admit that. So there's various ways that you can do that. Different price levels. So, for example, you see the high of this on this chart was about 3,600. You could say if it gets above 3,600, I'm going to move back in. You could do a relative strength, like we talked about. You could look at various chart patterns. There's a million different ways of criteria to do it, but having a predefined entry is incredibly important. It allows you to participate in these markets even when you don't want to, even when you don't think it's the right time to do it. What you think about how the market will happen. I've been in this business for 20 years, and I've seen everything happen that I thought would happen that I never thought was possible. But again, they're very complex systems, and I would try to avoid trying to predict what's going to happen. Just recognize what is actually happening and have a predefined strategy. I'll take a little pause for questions here before we go on to the third section. Nope. So let's talk about some of the foundations. We're going to use an example that we actually use with our client portfolios. And what are some of the foundations to build a reliable investment process? First of all, as I've said, there is no perfect system. Markets are incredibly complex. There is no one system that will always work, but there are unlimited effective systems. And what we're really trying to do is find an effective system to grow wealth and to protect wealth. One of the things that I think is very important, one of the philosophies that I believe is very important in investing is stoicism. And that's a recognition of what is, not what we think should be. And Epictetus was an ancient Greek Stoic philosopher. He was actually a slave early in his life, and he essentially became a very well-known Stoic philosopher. And he has a quote that it's not what happens to you, but how you react that matters. We can't control what the market's going to do. When you buy a stock or you invest money into anything, you don't control the outcome. So you need to be able to control your actions with what happens after you make that purchase or after you make that sale. So if you don't read Stoicism, I would suggest it if you're considering being a little bit more hands-on in the market. But we have to recognize our own psychological flaws. So 4 pillars that we believe should constitute a successful investment process. Again, simple to discuss, but difficult to execute. And we're gonna use each of these 4 pillars in a real life, what we use, a simplified version of a portion of portfolios that we use for clients. So first is developing a repeatable process. If you can get lucky once or twice or 3 times or 5 times, but understanding why you made a decision and being able to repeat that decision is absolutely critical. Then you can start to take some of the emotion out of it, which is the second piece, is you want to remove your own emotion from this process. It is very easy to get greedy and fearful and skeptical and optimistic that may or may not be appropriate for that given time in the market. So you want to be able to remove your own emotion from the process. Then ultimately what we're wanting to do is, in a good market, we want to participate in it. We want that account value to go up regardless of why. You don't always have to implement risk management processes. Markets tend to go up 70 to 80% of the time. So you don't need to be constantly executing your risk management strategy. But when markets get volatile, in those bad markets, you need to have a system that you can implement quickly. So participation in good markets and risk mitigate in bad markets. So let's look at an actual strategy. We're going to talk about all 4 of these pillars here. So this is a chart of the S&P 500 going back a couple of years. Like I say, this is sort of a simplified example of what we do, but this is essentially a trend model. And the blue line on the top is the S&P 500 index. The gold lines are one of our objective price measurements that we use to determine when we get out and when we get in. So if we're above those gold lines, we want to invest. If the market is below those gold lines, we, for the most part, want to be out. Again, there's some complexities to how to things that we're doing with our individual clients, but this is sort of a simplified version of it. So like I say, above those gold lines, invest, below, cash. So first of all, we want to have a repeatable process. These are objective signals that is not based on what we think is going to happen. So because how we view the market will change. We can't go back and say, okay, well, in 2009 at the market low, what would we have done? What would our market predictions have been? We want to be objective. So we need to be able to have a process that takes our emotion out of it. And again, has objective signals that's given to us by the market. Remove the emotions. So these signals are not, again, like I said, not based on how we feel. This is purely a data-driven, algorithmic expression of market price. It has no what we think about what may or may not happen is not a factor in this particular signal. And price is everything. So if we're going to participate in good markets and avoid bad markets, here's a really simple way to do it. For the most part, for that first third of the chart, highlighted in the green box, we're above that gold line. We want to invest. That's giving us a signal that says we can participate in that good market. The market went below that gold line. That would be a signal that we should probably be in cash. That would allow us to avoid a lot of volatility. Then early in April, the market moves back above that line, and we're back into an environment where we're confident that we can invest. And now we've gone below it, and we're back in cash. So this is something that, again, doesn't require a prediction or understanding the complexities of the market. It's a very, very simple system that simply responds to what the market's doing, responds quickly, and is completely objective. So, conclusion. I've said this a bunch of times today. You must have a predefined process, but you also must follow it. So instead of having a diversified portfolio, we think you should identify your maximum exposure. Not every portfolio is going to be the same. If you're very conservative, maybe you have 5 or 10% in stocks. If you're very aggressive, maybe you do have 90 or 100% of your portfolio in stocks. So use asset allocation to define your maximum exposure. Then you can start to diversify strategies, trend following strategy, like we talked about that example, a momentum strategy, growth versus value, having some non-liquid investments in your portfolio, like private real estate or private equity or private debt that does not price daily like the broad markets do. And then you can diversify signals. You can have some shorter term signals that's more responsive to the market. It's going to cause a little bit more ins and outs. You can combine that with some longer term signals that might have a little bit higher volatility, but is a little bit less sensitive to the shorter term fluctuations. So if you can put all these different things together, it can be a fairly simple strategy, but it will allow you to, again, participate in those good markets and manage risk in the bad markets. We have a few more slides, but I think we're at 12:40. I'd like to open it up to some questions and kind of respect everybody's time here.
Yeah, so we do have one inquiry about, and I think this is more related to, state of the market. It's an election year. We're coming up to it.
Yes.
What can we expect to see? Are there differences between who gets elected and what should we be mindful of?
Very, very, very common question that I'm hearing a lot right now. There's a few different things. I'll go to one slide here in a minute that I put together, but specifically with Trump versus Biden, I've seen some research. The common thing for Trump supporters is that if Biden is elected, the market's going to crash. And the common theme with Biden supporters is that if Trump stays in president, the market's going to crash. Historically, the elections don't have that much influence on stock prices. Historically, we get a little bit of a sell-off between now and election, kind of the 4 to 8 weeks pre-election. We see a little bit of a sell-off. We're kind of going along that same sort of rhythm this year. I have seen that this year specifically, there's a potential tax difference with presidents. So Biden has come out and made some announcements and has some policy ideas that he's published publicly that would increase corporate taxes, especially. The analysis that I've seen done is that it would probably result in an 8% net valuation decrease for the S&P 500. Whether that actually plays out like that, I don't know. Personally, I think that it is all about the Fed. The most important thing you can know right now is what is the Fed doing? In the 10 years prior or following the financial crisis, the Fed printed about $3.5 trillion, almost $4 trillion that they basically created from thin air electronically, and it made its way into the stock market. Over that 10 years of printing $4 trillion, that led to one of the biggest and longest bull markets in history. Since April, they've printed $3 trillion. The market went up 60% because of it. It's completely disconnected from the markets. From the economy. It's disconnected from politics. It's all about the Fed. And this shows the Fed balance sheet. So they're up to $7 trillion that they've basically printed and flooded the markets with. If one of the two presidents were to change the Fed chair, I think the market would that's the most risk to the market. It may be the right thing to do is to get somebody in there. Like, for example, the extreme example would be Ron Paul. If we had a Ron Paul come in as Fed chair and he stopped printing and he tightened interest rates, we would see a massive market crash. There's no reason to believe that if Trump or Biden are the next president, that they are going to shift the attitude of the Fed. Once people get in power, they don't want the collapse to happen on their watch. So Trump in 2016 was bashing the Fed and saying they were doing inappropriate things and they shouldn't be printing all this money. He became president and he wants the Fed to print money because there is a direct result of that is that markets go higher. The Fed has announced that they will print another 3 or 4 trillion. So they've already printed 3 trillion. They could print another 3 or 4. I think this is really all you need to know about the current market environment. At some point, it's going to be bad. At some point, having this kind of policy it's spiking the punch bowl at the party. And, they keep wanting to spike the punch bowl and extend the party out. At some point, the party's going to be over. It's impossible to predict when that's going to be. We could have already started if the market loses faith in the ability of the Fed to prop markets up, then it won't matter who's president. But as long as the market thinks, and as long as the actual liquidity that's being created in the Federal Reserve that is making its way into stock markets, that's causing prices to go higher, as long as that continues, we should expect markets to remain fairly stable, and if not moving higher. There's going to be periods of volatility like we've seen in that chart. But as I think, as long as the Fed is doing what the Fed is doing, I personally don't think it's going to matter who's president.
Great.
Great question.
Any other questions? Do we just go ahead and type them in the Q&A box or the chat box? Just got a few more minutes before we have to wrap up.
If we don't, I just want to say thank you all for attending. It's an honor to get in front of everybody. Thank you, Jessica and Upside, for having me. My email is jim.denholm, DENHOLM, at IronBridge360.com. Feel free to email me with any questions following this. Jessica, I believe this is recorded, and we're gonna be able to have this. We'll send it out after it. Maybe take out some of my stumbles along the way, but this is recorded, and we'll send it out to everybody. But thanks everybody for joining.
Yeah, we do have a question, and actually, if you want to go down to the very, very last slide, we have your contact information on there. Oh, did we miss that last slide there? Oh, there we go. There we go. So we have Jim's contact information there if you have questions. We do have another question that's come in before you wrap up, Jim, if you have time to answer it.
Absolutely.
Okay. The question is, how do you feel about real estate investments?
You kind of cut out there, Jessica. Could you repeat
sorry.
that?
The question was, how do you feel about real estate investments?
I mean, I think, real estate, it's all about the piece of real estate itself. I mean, I think we're in an environment where residential real estate has been absolutely on fire. Personally, I might be a little skeptical about certain office real estate. Given sort of a larger trend of work from home, I do think that one of the potential results of COVID is that more companies are going to reduce their footprint. But there are, for example, we're in Austin, and real estate ultimately is about demographics, and demographics here are very, very favorable. I contrast Austin with Detroit. Over 50 years, Detroit had a very consistent migration of people out and away from their city. That's not a good environment for real estate. But I think the right piece of real estate, interest rates are incredibly low. The Fed has said they're going to keep interest rates low for another 5 years. Whether they can do that or not is another thing, but with plenty of liquidity flooding the markets, with low interest rates, the right real estate deal can have some very, very nice returns.
Yeah, it definitely depends on the market where you're looking to buy as well. Location.
Right.
I know.
San Francisco right now, I would not want to be a real estate investor in San Francisco, neither real estate, office, industrial. Like I say, Austin is continuing to be a beneficiary of the demographic shift away from the coasts, away from New York and Miami and Chicago and San Francisco and LA. That is a favorable environment for real estate. So I think, just like anything, I think if you're selective and you have your right criteria in place, there's plenty of opportunity out there in real estate. I personally think that the overall market in a lot of different risk assets has plenty of room to move higher. Again, our process is not dependent on that. Our process doesn't really care what I think, but we just saw a 40% market crash 6 months ago those tend to not repeat themselves very frequently. It would be a very, very rare event. It's happened once in 200 years of recent market history that if the market were to experience another 30, 40, 50% decline, it would be the second time in history. The first time being 1929. So with the liquidity out there, we should expect some volatility. You never know when the next decline is going to happen. So you need to have those preset strategies in place. But, in statistically speaking, we probably have a few years of a flat to higher markets. And I think that environment would be beneficial to real estate. I think that's beneficial to stocks. It's not beneficial to bonds. We personally don't think bonds have a very good risk return at all. So we are very tactical with our bond exposure. But the overall environment, despite the risks and because of the Fed, looks fairly favorable. And like I say, I think if you just keep in mind, don't stay invested too long and don't stay in cash too long, and try to develop a systematic process, you will benefit from it. And you will participate in those times where it might be confusing and it might not make any sense, but your investment statement at the end of the month, it's like there's a saying in golf that there's no pictures on the scorecard. So if you made par, even if you hit it off a tree and it's went off a rock and somehow luckily went in the hole, it's still a par. Your brokerage statement doesn't care what you think about the market. It's either up or it's down or it's flat. So let's try to make it go up.
Yeah, and I'll also reference our listener to the person who asked the question. We covered last month in one of our webinars just the state of the multifamily market specifically, and how in times of pandemic and times of whether it's catastrophes like earthquakes and whatnot, how multifamily has been pretty stable. Everyone needs a place to live in the end. So, and it depends on what asset class. So there's that to keep in mind as well. One last question here. Is the U.S. economy and stock market going the direction as what Japan was in the 80s and 90s?
It could. It very well could. If you're not familiar with Japan, what happened in the 80s in Japan is that they embarked on a very aggressive money printing campaign. If you remember, or if you've read about it, they bought Pebble Beach, they bought Rockefeller Center. They were, Sony came out. Everybody was excited about the companies that were happening in Japan. The Nikkei, which is the Japan stock market, had a high point in 1991, and to this day it's still 50% lower. So they are in a deflationary environment that they have not been able to get themselves out of. They brought interest rates to zero. Again, they printed money, but it was not a favorable environment at all. So that is one of the scenarios that could easily play out. If the markets lose faith in the Fed's ability to prop up markets by printing money, we could see a very long-term period of U.S. stocks being flat to down. It kind of goes to that one chart that I showed that, there are 20, 30-year periods where you don't see any growth. And that is incredibly detrimental to an individual and a family if you're not prepared to handle that kind of environment. I wouldn't go through and necessarily predict that, but I do think that there ultimately will be consequences to what the Fed is doing. And it very well could play out like the 90s. Now, a couple of different things that the U.S. has as far as an advantage over Japan is a much more favorable demographic makeup. There was, Japan very much was an aging population, and they did not have sort of the baby boom post World War II. A lot of economic activity is based on demographics. With the US following World War II and the baby boomers, that was a lot of consumers, that was a lot of entrepreneurs, that was a lot of people selling stuff to other people. And that caused a pretty big, 50-year generally rising stock market. The average boomer had 2.5 kids. So there was sort of a pig through the snake, for a lack of a more appropriate analogy. You had this massive explosion in the population, and then the boomers all had 2.5 kids, and you've got this other massive explosion in the population. So the demographics are the one thing that I would say would potentially not have the U.S. follow in Japan's path from the 90s and to today, frankly. But that is there are a lot of similarities, and if the market does not, if it starts to respond unfavorably to the Fed, we could easily go down that path. I don't think that's going to happen for a few years, though. I don't think that started today. I could easily be wrong, but I do think that we have a few years left before we start seeing the real consequences of what the Fed's doing.
Wonderful. Thanks so much, Jim, for sharing your knowledge and providing some really helpful tips, and giving some really good insight on how to protect our investments, especially in times of volatility. And thank you to our listeners for joining us. If you'd like to contact Jim, we've shared his contact information on the screen. And let us know how helpful this content was by taking the short survey at the end of today's session. And also let us know if you have any other financial and investment topics you'd like us to cover. We'll find subject matter experts like Jim who can speak on these topics, because at Upside Avenue, we're committed to helping you live your upside. So watch your email for next month's webinar, and follow us on Facebook, Twitter, LinkedIn, and Instagram for the latest industry news and insights. And we also have a library of past webinars on our YouTube channel. So discover your upside with Upside Avenue. Through our non-traded REIT, you can enjoy the benefits of real estate investing for as little as $2,000. You can visit upsideavenue.com for more information, or send us an email or call us. Thank you for joining us. Thank you again, Jim. Everybody, stay safe, and we'll see you next time.